Hi, my name is John Stevenson, and welcome to the Guaranteed Retirement Guy Show. Today, we're going to be talking about current caps and also participation rates in indexed annuities. So when you're thinking about growth from an indexed annuity, you also have to realize that growth will be limited to the cap or the participation rate or even a spread that the insurance company will impose upon it. Why is that? Well, insurance company has to make money, right? Because in return for zero risk to you, they're taking on a risk because they're purchasing call options associated with these indexes. And if the indexes rise, then of course they're able to exercise the options, the call options that they purchase for these indexes. And it could be an index with the S&P 500, Barclays, NASDAQ, USB, so many different indexes are out there. And the cost of the options to participate in those indexes fluctuate a lot because market changes, you got rate changes, you've got stock market changes, just things that go on in the world that will affect the price of the option. And because of that, they have to change those par rates, those caps, those spreads. And that does change from year to year. If it's a 1 year point to point, or if it's a 2 year point to point, then it's locked in for the 2 years. But keep in mind, if it's a 2 year or even a 3 year, or even a 5 year, a lot of the PIMCO indexes I see will have a 5 year participation rate of like 500%. Which you think, oh, that's so great, right? If I get 10% growth in the index, I'm going to get 50. Yes, you will, but keep in mind that index may go up really, really well in 3 years, and you may lose all of your earnings if it goes bad for the next 2 years, and you haven't even got your first credit. So at the end of that 5 year period, if you get a zero, you're not going to be very happy. Now, that's why I always tell people, if you're going to participate in these indexes, try to do a 1 year, or at least put a combination of several 1 year indexes point to point, so that you're able to get more compounding periods inside of the time that you're in that annuity contract. Okay, so if I can capture growth of 3 years, but still be protected against 2 years of downturn, at least I got 3 years, right? It's better than having a 5 year huge participation rate that I never realized any gains from. Okay, so keep that in mind when you're looking at indexes. The other thing you have to remember is if you're looking for highest income, none of these indexes, par rates, cap rates, none of that matters at all. Okay, if you're looking for highest income, then don't even worry about it. Okay, just look for the highest income annuity that gives you an income rider that grows at like 7 to 9% guaranteed until you take income. That's what you want. When you're looking for pension money, that is the most important factor. If you're only looking for growth and market protection, then listen up, because you're going to like what you see. Okay, because we're going to be diving in, doing a deep dive on some of these caps, some of these par rates, and also there's a few spreads. Okay. All right. So you'll notice that I'm sharing my screen, and I have not put any filters in here at all. It's showing everything. So it's showing B++, it's showing some A rating companies. I mean, you got A+ there. You got some indexes that have no fees, some with fees. Keep in mind, if there's an index with a fee, it's because they're charging you a fee to have a higher participation rate in the index. Okay, so just keep that in mind. So if you're thinking, oh, I want to have 200% participation rate in this, and I'm willing to pay 1%, you can do that. Just do it during a time where the market's doing well, so that your fee is not wasted, because when the market's not doing well, they're still going to take that fee at the end of that period. Okay, so remember that. But so I'm going to, obviously you can see 3 year, 2 year. The 3 year here is paying 550% with Sentinel Security. Okay, it's a great example. And I'll show you what that looks like as far as illustration purposes. And I also want to make sure that you are aware and beware of agents who will try to sell you this based off of illustrations like this. All right, so you've got the guaranteed side, which is showing zero interest rate credited, which just means worst case scenario, if the index delivers nothing, then you'll earn nothing. And you can see the contract value going down because they're charging fees. But it looks like over time it actually, well, no, it still goes down. So that's from fees. So basically, we're looking at a 3 year Credit Suisse. Let's take a look at this. It's a rider charge. That's what it is. So you see, I have a rider charge right here. This column, $6,000 a year. That's a lot. So let's take a look at the rates of growth. Wow, look at this. 73%. 118%. Because remember, this is a 3-year. They're measuring 3 years of growth. And so as long as the participation rate stays at that 550%, you're going to get huge amounts of growth. In fact, if you look at from year one, $650,000, and you let that grow for 20 years, that's going to grow to $27.8 million. Wow, what a return, right? Yeah, I wish. So it doesn't happen. I'm just telling you that right now. The average index growth for the last 30 years for indexed annuities is between 5 and 7%, rule of thumb. I have seen them do double digits, but I don't illustrate it. Okay. All right. So let's go back here, and I'm going to change a few things. I just kind of want to show you an example. I'm going to go in here and say, you know what? I don't want any fees. Nothing. Okay. I still want to see the caps and the spreads and the par rates, but I don't want any fees. Okay. And then I want to go in here and say, you know what? I also want to limit this to the S&P, because the S&P is something that we all follow and we all understand. There are some indexes out there that are pretty fancy, but have only been around for a year. And so they can show some pretty good returns because we've had some decent returns. All right, so S&P, you can see here's an example of a 5-year. They're measuring the S&P for 5 years. So if you got 3 good years and 2 bad years, you're not going to earn a dime, right? So I do like to, if I can have more frequent resets, then I'll take them. So I'm going to change this to annual. All right, now we're looking at something solid here. Okay, so you can see here the participation rate is 80% for the top one, Security Benefit, and it's an A-rated company. That's not bad, okay, but they also have a spread of 3%. So that can really reduce the money that you're making. But even with that, it has a long track record because it's the S&P. So last 20 years, if you were participating in this type of index and nothing changed as far as the participation rate and the spread, then your average return would be 7.75. Okay, simple. You got some other ones. The standard has a few. You can see 20 years, like a little bit higher, 7.88. It's not bad. Delaware Life has a few. Ocean View. Now look at the Ocean View one. See the cap? It's 13%. Okay, that is a big deal because the S&P has been doing very, very well, and the returns have been great. And so it's been hitting that cap a lot. And so that's why they're showing average return of 8%, because there's been some years where it's down and those years are 0. So if I go in here and illustrate that, all right, so if I look at, and again, this has no fee. So you'll notice on this one, it's a little different than the one with fees. That contract value here stays the same. It's $650,000 because there's no fees. And it's showing this is what happens if the S&P delivers nothing, which, well, we got bigger problems at that point. So, but here's what I like about this. Guaranteed minimum value actually goes up. The cash surrender value matches it. And the death benefit's still the same. So that's interesting. But anyways, if you look at the guaranteed minimum value, if you die, that's what they're getting. So death benefit is the death benefit. But if you're leaving it to your beneficiaries, they're going to get the account value. So what I like about this is they have a guaranteed growth rate. So if you leave the money in there long enough and the S&P does nothing, they're still going to give you, at the end of 20 years, $988,000. So I like that. Now let's look at the average growth. Okay, the S&P, again, has done well. So if you get that average growth and if the cap stays the same, there's no guarantee the cap will stay at 13%. Okay, they will change this every year. Sometimes they don't. Maybe they'll even raise it. Okay, but I do see them lower it at times as well. Okay, and that's happened this year a number of times for Mass Mutual. They've lowered their cap several times. People that got in early, though, they had that cap locked in. So keep that in mind. But anyways, if we look at this same 20-year period, this 650 grows to $2.9 million. Well, that's actually really, really good. So that is realistic as long as that cap stays exactly where it is. And that is not realistic. Okay, the cap will change. So keep that in mind. Here's the thing with index annuities. You have to think about risk reward. Okay. You're going to have times where they will lower the cap, and they might even lower it to 8% 1 year, okay? Maybe 2 years. It happens because the cost of the options are expensive at that point. The market's fluctuating, and they have to make a profit, and maybe they've taken some losses for the years where it went down and they could not exercise those option contracts. So they had a cost, right? They were not able to realize a gain from those costs. And so a lot of times they have to kind of adjust, okay? Change par rates, change cap rates. So you have to realize that they do not guarantee the cap rate will stay where it is. But currently, it's great, okay? So that's what I look like. That's what I look at when I am looking for high cap rates. I'm looking for usually indexes that have been around for a long time, like the S&P. Okay, let's go down a little bit. We got NASA, B++ company. They're giving you a 62% par rate. See, some of these will only give you participation rates, which means they'll just give you whatever percentage that index does. So it's very cut and dry as well. So there's no cap. So if the market does 20% one year, you're going to get 60% of that 20%. Now, if I go back up to security benefit, they're going to give me 80%. Well, that's pretty good. If the market goes up 80, if it goes up 20% and I get 80% participation rate, well, what am I going to get? I'm going to get 16%. That's pretty good. Okay, that's higher than the 13% cap that I'm getting from the other one, from Ocean View. Okay, so that really does make a difference. When you have participation rates that are high enough, they can actually deliver more returns than a cap will. Okay, all right. So let's go over here, and I'm just gonna take away, make this easier to look at. Okay, here's an easy one. Midland National. Midland's a great company, by the way. They've been around for, I want to say 119 years. But what I like about this is it's got 8 surrender years, which means the surrender charge period for you to access more than that 10% free withdrawal. If you access more than that, they're going to charge you a surrender charge. But at the end of 8 years, it's all gone. What I do like about this is this is just a spread. It's very simple, cut and dry. It's 3.5. So you get whatever the index does minus 3.5. Now, the index goes down to, 5, 6, 7% negative. Well, you're not going to lose money on that. Remember, they're protecting you against that. But any gain, they're going to take a spread. Okay. So let's take a look here. All right. Again, guaranteed side shows the same 650 if nothing happens. Guaranteed minimum value goes up, which is pretty nice. And of course, if we look at actual growth numbers, look at this. It's interesting. So over a 20-year period, it grows to like 1.279. Wow, what a difference. What a difference that spread makes. So, and when you see the 3.63 here, what they're doing is they're showing the last 10 years what this particular index and the spread would have done. But then they revert to a 30-year average. Okay, so I think the average is higher than that, but they go with a very conservative number just to kind of give you a baseline. So keep that in mind. So let me check in here. I just wanted to see exactly what allocations this one has. It does have the S&P Mark V. That one actually has averaged more, but it's only because of the 130% par rate. Okay, the index earns 10, you're going to get 13%. Okay, so you notice there's a cap of 7.75 for this one. They got the Fidelity multi-factor. There's a 0% spread. So this one, there's no cap. There's no par rate. It is what it is. So you'll earn whatever it gets. That's kind of nice. So, but they do have a spread of 0%, which means they could change that next year. Okay. All right. 2 year, look at the 2 year, 200%, 200%. And then they got a 1 year fixed account, which is very similar just to a CD. If you want to just throw money into that, you can get 3.2. But of course, if you're doing an index annuity, I would recommend you play with the indexes. Okay, you typically will have more growth that way. All right, so I hope this has helped. I really just wanted to break down kind of how these annuities work as far as participation rates, cap rates, and spreads. Now, sometimes they will use a combination of these. They might give you a spread, a participation rate, and a cap, and they all work together. A lot of times they'll say, hey, we'll cap you at 10% and we'll give you a 300% participation rate. To me, the 300% participation rate doesn't mean too much when I'm already capped at 10. I'm going to get a huge participation rate. I mean, that's going to mean something to me. If the index only does 3%, then yes, I'll get 9% growth, right? 300%, and it's capped at 10. But if the index does 10%, I'm not going to get 30%. I'm going to be capped at that 10%. So a lot of times when I look at indexes, I would rather just have one or the other. I don't want to have a mix of them just so I can have more chances of growth. And so when you meet with me, we'll look at all the top growth options. Now, again, this is for growth. Okay. If you want income, that's a completely different conversation. Okay. There are income annuities out there that pay you a ton of income, and they have different rates of return for that income benefit. Okay. That's completely separate from what we've been looking at here. This is, as far as par rates, index rates, and spreads, all that matters is for our actual account value, the money we can actually take out to, spend, live off of, or roll over to another account. Okay, that's all that affects. Okay, as far as income, that's completely different. So hope this helps. If you want to book a call, there's a link below this video. We can chat about your unique annuity situation, what you're looking for. If you're looking for income, great. We'll look at those annuities. If you're looking for growth, there are certain annuities that are best for those. I tend to favor some of the A+ rated companies like Allianz. They've got some decent ones. Midland, North American's got some decent ones. But some B++ companies have good ones as well, because they have to be more competitive because of their rating. So we can look at all of them. Happy to do so. So anyways, hope this helps. If it does bring you value, please like, subscribe, share, and I'll see you in the next video.